With the gyrations in interest rates that we've been seeing lately, investors have been focusing on key stocks in the financial sector. Dom Chu is here, and he's got to look at a lot more on this. Dom, happy Friday.
Hey, good morning, Becky. Good morning, Andrew. So the S&P financial sector is pretty much flat year to date, but there are a ton of industry stories in that sector overall. So we're going to start this Sectornomics day with the big banks. And one of the biggest of the big name banks in 2025 has been Bank of America, and it's seen the biggest drop, down almost 10%. Morgan Stanley's down roughly 8% in that span. Goldman Sachs down roughly 5%, and a 3% drop for Citigroup so far. JP Morgan is now up 2%. Now, so far this week, they're pretty much up across the board, as Andrew points out. It's been a great week for the markets. Citigroup and Wells Fargo are both up 7.5%. 7% for Goldman shares, by the way, 6% for Morgan Stanley and for Bank of America as well. Now, if you take those big banks versus the pure play regional banks ETF, the ticker IAT here, you'll see that the big guys are faring much better. IAT is down roughly 13% in 2025, and that includes names like PNC Financial, U.S. Bancorp, Truist, and M&T Bank as well. Ohio's big three, Fifth Third, KeyCorp, and Huntington Bank shares all part of the mix as well. Now, the big banks have suffered since President Trump's April 2nd tariff announcement. Citi and Bank of America in particular on the shortest end of the stick. Goldman Sachs CEO David Solomon summed up the trouble in an interview with, of course, Becky just on Tuesday.
There was a lot of optimism around a lower regulatory environment and changes. And so now we're a few months into the administration, and instead of policy becoming more certain, we actually have a greater sense of uncertainty broadly, and it's having a big impact on asset prices and markets.
Now, Solomon was addressing stocks at large, but the same applies for how investors are seeing the banks. Uncertainty isn't really a friend. Now, on Squawk on the Street today, we're going to focus on a part of the financials that is actually outperforming everything else in the sector. And it's not exactly the banks. That's kind of a hint there. But, Becky, that Solomon comment that you guys had on Tuesday kind of echoes around that big bank trade so far this year.
Yeah, I mean, the uncertainty still being out there, but Solomon's other point was that around the margins, these things may matter, but the huge, overwhelming concerns about what this means for the U.S. markets, for the dominance in U.S. markets, he thinks is overblown because he just doesn't think there's going to be other places for you to go, ultimately. These are the deep markets. These are the liquid markets. These are where the best companies are. And to some extent, that will help protect us. Now, again, around the margins, agrees that that's an issue, everything that's happening with the trade wars. But ultimately, this talk about the dollar being no longer the reserve currency, I think he thinks is overblown, too.
No, and that's the talk I'm hearing. A lot of it is it's all on a relative basis. Right. There's nobody who's talking, Becky, about the fact that the dollar is going to lose its reserve currency status. It's arguably the only reserve currency in the world, and you still have gold, oil, all the major commodities denominated in it. And by the way, treasuries you can talk about, but at the end of the day, if you really want to move massive amounts of money and park it someplace, there is no other sovereign bond market in the world that rivals the U.S. Treasury side of things. So it's all, yes, on the fringes, but a lot of investors, that change perhaps in thinking, that paradigm shift perhaps, is what has a few investors out there maybe a little bit more worried.
Sure, and explains the moves we've seen in treasuries recently, too. And by the way, even minor moves on the margins can make a big difference to average Americans. You know, those moves in the 10-year Treasury, 1 percentage point, can make a big difference for somebody trying to buy a house or a car or something else.
And no doubt about it. And by the way, the idea now that you have the futures market, the financial futures market, looking at pricing in more aggressive rate cuts down the line shows you just how much traders are starting to kind of take all of those things into account as they project future Fed policy.